Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Air Transat could start canceling some flights tomorrow. That is affecting the stock price today. It comes as the union representing more than 700 pilots issued a 3-day strike notice. It could begin as early as Wednesday, that strike. The airline says there will be a gradual suspension of operations to prevent passengers, crews, and aircraft from getting stranded abroad. The two sides have been negotiating over the past week, hoping to reach an agreement before the deadline. Shares of Canadian packaging and printing company Transcontinental are surging. The company agreeing to sell its packaging business to U.S.-based Pro Ampac Holdings. It has an enterprise value of $2.1 billion, including debt. And Transcontinental says the move will allow it to focus on the transformation of its retail services and printing and publishing segments. China's trade surplus for the year has topped $1 trillion. Leaving the country, exports leaving the country climbed in November after a contraction the month before. China saw exports surge to destinations like Southeast Asia, Latin America, Africa, and the European Union. But shipments to the U.S. dropped about 29% year over year. Paramount now offering to buy Warner Brothers Discovery for U.S. $30 per share in cash, and has taken that offer right to Warner Brothers shareholders. It comes days after Warner agreed to a deal with streaming giant Netflix. Paramount says its offer provides shareholders with U.S. $18 billion more than Netflix. The offer is for the entirety of Warner Brothers Discovery, including its global networks segment. The TSX today dropping 137 points on the day to 31,745. Let's go to the U.S. side and have a look at the S&P 500, which has dropped 34 points, about 0.5%. The Dow Jones at the 265-point move down on the day, so more than 0.5%. And the NASDAQ a 77-point drop. Markets are in the red, as you saw just a moment ago, as investors wait for rate decisions to come on Wednesday, both in the U.S. and here in Canada. The likelihood of a rate cut by the Federal Reserve seems to be priced in. The Bank of Canada is so far expected to hold. Let's dig in with Jay Balla, CEO and Senior Portfolio Manager at AIP Asset Management. Thanks for joining us today.
Oh, thanks for having me in.
Okay, markets seem fairly quiet today. Do you think investors are kind of just waiting to see what happens Wednesday? Because most people seem to believe there is a rate cut south of the border we're holding here. So what's to wait for?
Sure. I mean, I think it's a good question. I mean, I think there's always that anticipation of, what happens next. Will, the Fed or the central bank say anything in those meetings? But I think you're correct. I mean, I think it's pretty much factored in at this point. Canada's probably going to hold, and the U.S. is going to cut rates.
Okay.
Right.
Where are you seeing rotation going these days?
Sure. I mean, I think where you've seen a ton of rotation is people that have looked forward a few years and they're saying, well, okay, what's my fixed income portfolio going to look like for the next few years, right? Are these interest rates going to come down and then come back up? Or are they going to come down and stay down for the next few years, like we've seen, after the great financial crisis, after we've seen after COVID, where you've had that steady state, right? Like where interest rates came down and then stayed really low for a very long time. And I think, where you're seeing rotation is a lot of people are looking to figure out ways of getting income streams, right? And so they've looked at convertible debt. People are looking at private credit. People are looking at anything that's going to give them sustained income streams for the next few years, right? Because if you think about a traditional portfolio, kind of a 60-40 model, where 60% of your portfolio is in equities and 40% is in fixed income, well, if interest rates are going to come down and stay down, well, your 40% is in some serious trouble if you don't do something. So we've seen a lot of intelligent investors already start asking those questions and to ask about really, what are my option sets for the next few years? How do I lock in rates and at least sustain that low interest rate environment for the next few years? years.
Okay, so Bank of Canada, everyone thinks will be a hold, and then next year, do you think there is a possibility of rates moving up?
I don't. And I always go back to sort of first principles and, maybe look at sort of the simple mathematics behind interest rates, right? So if you look at the US economy today, it's a $35 trillion economy. Its debt is also $35 trillion. And so, the US economy is a developed economy, which means they can only grow at 2 to 3% a year, maximum. So if they have a place where interest rates are higher than 3%, well, that just means the debt's going to outgrow the economy, if all else equal. And so they have to force the rate down. So the interest rate has to be lower than growth rate. And so, one way or the other, they have to maintain low interest rates because the other choice is an uglier choice. It's austerity. You'd have to cut expenses. You'd have to go and talk to the general population and the voter base and say, hey, listen, vote me and I'm going to cut everything. And, that is not a very easy thing to do. And so from the Canadian perspective, if US is going to keep their interest rates low, ours cannot be much higher. Otherwise, it'll cause our currency to become stronger, which means, we export less. It's a tougher sale process for us, right? So, we're going to have to compete with the US, meaning, if their rates are going to stay down, we're going to stay down.
Where are you landing these days on AI? We saw a lot of trade moving away from some of the big tech in the last number of months.
Sure.
As you said, moving more to sort of things that are cyclical or things that they feel better about over the longer term. Mm-hmm. What are you seeing these days and what are you doing with AI trade?
Sure. So with AI, I think we need to do two things. We need to separate the stock price itself from the actual use case. And so I'll compare that to the internet from the 2000s because that's the easiest comparison, right? So, in that period, you had seen the stock prices go way too high, then they came way too low, and then they reset again. But if you look at that entire period from, say, the early 2000s to now, the internet has never, ever stopped growing. It's always grown. It just never grew as fast as people thought, and then it grew better than people thought, and then it kind of leveled out. And AI is the same thing. It's a change, right? Like, if you look at your kids or if you look at sort of young people, they use it more and more. I use it in my daily life, and it's not going anywhere. So, for the next 20 years, it's a growth pattern. Now, will these stocks overshoot? Maybe, right? Will valuations come down? Possibly. And, it's also difficult to kind of figure out winners. And so that's why we always suggest two things, right? If you look at AI as a pure play, every single one of them is private. There isn't a single pure play AI company that's public, right? If you look at OpenAI, xAI, and Anthropic, those are your three biggest ones. Not a single one is public. The second one is, look, it's very hard to determine which one of these is going to be the winner, who's going to be the Amazon of AIs, call it. And so the answer is, look, diversify. Buy all three, or find a way to have a nice diversified pool, and then, that's kind of your longer term bucket. That's, you're in it for the next 10 to 15 years, and you're going to do incredibly well owning those three names for a very long time. Right?
Okay, so I like the buy all three, sort of dip in at each, but then watch and determine sort of which one, as you say, is going to be the Amazon, and then perhaps shift your money over?
I mean, I think there's a natural loss rate, right? Like the winner's valuation goes up, the loser's valuation goes down. And so you have a natural kind of loss rate as you go up. But the reality is this, the winner is going to be a 10-bagger. The loser is going to be a loser. But, you'll make more than enough money on the winner that'll offset the losses of the other two.
Interesting. Okay. All right, Jake, I'll leave it there. Thank you for coming in.
Perfect. Thank you so much.
Coming up next, Paramount Skydance launching a $108 billion takeover bid for Warner Brothers Discovery. What about that deal with Netflix? We'll tell you what happens in just a moment. Paramount Skydance has launched a $108 billion bid for Warner Brothers Discovery, but Netflix has already announced a deal with the studio. We spoke to Julian Klimachko, CEO of Accelerate FinTech, about this.
2025 was really gearing up as the year of the mega deal, while markets in the merger and acquisition environment got off to a rocky start in 2025 with the new Trump administration. It's certainly turning out to be a make M&A great again type dynamic where you've seen a massive surge in mergers and mega deals, particularly in the United States, and this historic takeover battle for Warner Bros. Discovery is kind of the final end to what's shaping up to be a record year for deals.
And what do you think is driving this battle? Is it there just hasn't been much?
Well, several things. So markets have stabilized and boards of directors and executives are clearly very confident in the economic future. There's a deregulatory push that the Trump administration is implementing. Capital is flowing freely. The debt capital markets are fully open, as are equity capital markets. So raising capital for M&A seems readily available. And certainly with this deal, tens of billions of dollars are going to be needed. So it's a mix of equity markets doing well, debt capital markets open, financing available, and a regulatory regime that allows M&A to be struck, and it's to be seen whether these deals will be allowed from a regulatory perspective.
Which one do you think would be more likely to get through with fewer problems?
So this takeover battle for Warner Bros. Discovery is unique because Netflix, which has a friendly deal that they struck just one business day ago on Friday, they have an upper hand from a financing perspective and the ability to close this deal from an operating standpoint, just due to their scale and their size. However, from an antitrust perspective, Netflix's acquisition presents quite the challenge. I believe that since their pro forma market share in streaming will be 30 to 40%, a level in which the Department of Justice will certainly take a close look, and in my opinion, will likely challenge the deal to block it in court. So the Netflix bid faces pretty significant antitrust risks. On the other hand, the Paramount Skydance deal, you got to remember, this is an acquirer that's trying to buy a target that's nearly 4 times their size. It's a minnow swallowing a whale dynamic. And whenever you have that size differential, we're talking about the largest hostile takeover of all time, $108 billion, largest of all time by a long shot. In addition, the largest leveraged buyout of all time. So with that comes financing risks and execution risks. And I think closing a $108 billion deal, or perhaps even going higher, because these two are now in a bidding war, that will be proven difficult for both parties.
And is this bidding war worth it to them? Who wins? Do filmgoers win? Does the average person win if Paramount gets it, or does the average person do better if it's the streaming that takes it over?
Well, this deal touches a lot of people. I think that Hollywood, specifically movie producers, everyone in the entertainment industry seems quite concerned about Netflix acquiring Warner Bros. Discovery, because that has big implications for the box office and the movie theater business. Meanwhile, Skydance, they will probably be more friendly to Hollywood and the box office. So that's one of the strategic implications of their deal. And then from a consumer's perspective, there's not a lot of streaming services out there. Typically, people are looking at Netflix, Amazon, Disney, or HBO. And so if Netflix acquires HBO as part of this Warner Bros. Discovery deal, there's not a lot of additional choice for viewers and consumers for their streaming needs. So there's concern that the pro forma entity, if Netflix were to win this transaction, would be too great, and they would have significant market power to further increase their prices. Now, Roger, I don't know if you're a Netflix subscriber, but I've seen my Netflix bill go up and up and up over the years.
Julian Klimachko, CEO of Accelerate FinTech. Coming up, The union representing pilots for Air Transat issuing a 72-hour strike notice. We'll tell you what that means when we come back. Air Transat says flights will go ahead today as planned, despite the pilots' union issuing a 72-hour strike notice. For more on that, let's go to BNN Bloomberg Lindsay Biscaya. She joins us now. Confusion, I'm sure, for many who have flights booked and are wondering.
Yes, exactly, because originally there was talk that Air Transat might be postponing or halting flights as of tonight. There's still the plan to do that throughout the day tomorrow because, of course, that strike notice is set to start on Wednesday if there's no deal reached between now and Wednesday. So, yeah, it's confusing for passengers. If you do have a flight tonight, of course, now it sounds as though that's resuming as usual. And the airline says it has launched a special program today to bring back as many travelers as possible, thanks to 4 additional flights that went out to try to bring as many people home, as many staff members home as well, before there is that potential strike. Still no word on tomorrow. That's coming from the airline. At this point, then it's their wording earlier was that they would be halting flights by tomorrow, so no update in that sense. But there is a statement from the airline coming out this afternoon saying both sides were back at the bargaining table today, and, quote, while some progress has been made, there is still work to do. So obviously, the two sides here still talking. We know that, this is kind of the latest for the airline. It has been struggling when it comes to finances over the last couple of years. It accumulated quite a bit of debt throughout COVID, and we saw shares go down by 84% since 2020. So it's done some restructuring this year to kind of get out of that situation that it was in, to kind of lose some of that debt. Some of that has worked, but we were speaking with an aviation specialist today, Robert Kokonis, who said that, while Air Transat did try to turn some of its debt around this year, it's not out of the woods yet. Here's more on what he had to say.
And if we remember back in January, the federal government stepped in to provide some relief for the large enterprise emergency funding facility that was put up in place during COVID. Transat never really ran any long-term debt before that, and they really struggled coming out of COVID with that. So the federal government helped us slice a few $100 million off that amount. So that's great, more stable balance sheet. And they have been putting in some profitable quarters this year, which is great, but I wouldn't say they're out of the woods yet.
Yeah, and so the airline also dealing with some control issues in its boardroom when it comes to investors. Some have been quite vocal about the number of board members within the airline. There's 11. Some want to cut it down to 6. They also want to restructure the balance sheet. So this strike notice coming from the union representing pilots for Air Transat is kind of just the latest speed bump in all of this.
Making it even more complicated.
Yeah.
All right, so what are they negotiating about? What is the union asking for?
Yeah, so at this point, the union hasn't been very clear in terms of what they're asking for, but what they do say is they want better pay and better working conditions, something in line with what pilots with Air Canada received earlier this year. Air Transat has offered pilots a pay raise of 59% over 5 years, as well as, quote, major improvements to working conditions. Not quite clear on what that means. But it's interesting because Air Canada pilots settled for a 42% bump over 4 years. So that's a 10% increase each year for those pilots. If Air Transat pilots were to accept this 59% over 5 years, that would be more than 11% increase year over year. But it sounds at this point as though the two sides still very much at the bargaining table tonight, trying to maybe work something out before Wednesday.
And travelers hanging in the balance. All right,
Yeah.
Lindsay, thanks for the update. A new report is calling into question the Carney government's plan to double the pace of housing construction in this country. CTV's Annie Bergeron-Oliver has more.
We need to get housing supply up. In fact, we need to double housing supply on an annual basis.
Prime Minister Mark Carney's campaign pledge to build nearly 500,000 homes annually so far isn't adding up. According to a new PBO report, Ottawa's new federal agency, Build Canada Homes, is projected to add 26,000 units to the housing supply over the next 5 years, a 2.1% increase over the fiscal watchdog's baseline projection for new home construction.
I think I would give them a C- when it comes to housing. That overall, I think they are moving in the right direction, but not at the speed and scale that's necessary.
The housing minister doesn't see things the same way. He says Build Canada Homes is just getting started and that the PBO's numbers don't tell the whole story.
I think that's just based on the raw number. It's not based on attracting a lot of investment from provinces, from the private sector.
By harnessing private and public sector funding, Ottawa intends to double the pace of housing construction. But so far, it hasn't released a clear plan plan to achieve that goal. And overall spending on housing, according to the PBO, is set to drop by 56% over the next 3 years as Trudeau-era programs expire.
A lot of the mechanisms that the federal government used weren't terribly effective in creating the affordable housing that people need the most. So I welcome the restart represented by Build Canada Homes, but we have to see a lot more.
The PBO report assumes that major programs like the $4.4 billion Housing Accelerator Fund will not be renewed or topped up. The finance minister, however, says it's not fair to prejudge what decisions the government will make between now and 2029. Annie Bergeron-Oliver, CTV News, Ottawa.
A new Nano survey has given insight into how Canadians are feeling about the federal budget. CTV's Jeremy Chiron has more on that.
It's a book filled with big promises, but Federal Budget 2025 doesn't do enough to help Canadians with their finances, according to a new survey.
The budget has a long-term vision for jobs. Maybe it's put a spotlight on the fact that good economic policy might not make for good politics.
A new Nano survey conducted for CTV News shows less than 1 in 5 Canadians think the government's fiscal plan will help them financially. In fact, just over 1 in 3 believe the budget will in some way worsen their personal finances.
That's not a very great number for a government that is looking to build confidence in Canadians who are struggling to pay for the bills.
Meanwhile, the budget bill itself is far from becoming law yet.
It's a minority parliament, so getting legislation passed is a challenge.
The official legislation is still stuck in the House of Commons being debated and has several hurdles to cross still, with only a week left on the sitting schedule this year.
You can't actually start to move on those provisions. You can't get a second reading vote. You can't get it passed into law. And so that's going to start to affect real things. Measures that were planned to be implemented in January might not.
The honourable member. A political roadblock the Liberals could continue to face in the new year, even though Green Party leader Elizabeth May is leaving the door open to supporting the Liberal government in the future, despite recently saying her vote in favour of the budget was a mistake.
I'm a bridge builder, and I never say never.
May says her vote moving forward would require a change in policies.
I can't vote confidence on the current policies, period.
And so the Liberals seem poised to start 2026 how they're finishing 2025, fighting to get a major piece of legislation through the House of Commons and without a sure way to survive the next confidence vote when it comes.
CTV's Jeremy Chiron reporting. Let's have a last look at the North American key markets before we end the trading day. The TSX Composite started the week 147 points down, almost 0.5%. The S&P 500 34 points down. That is a 0.5% move down on the day. And the Nasdaq a 66-point drop. We'll show you the end of day numbers when we come back. Stay tuned. All right, here are the bells for the end of the trading day. At the Nasdaq, Inseego ringing the closing bell. In New York, Sunoco LP and Sunoco Core ringing the closing bell. And then at the TSX, Santa Claus comes to Bay Street just for the day. You're watching The Close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite ended the day almost a 0.5% down, 141 points dropped to 31,169. The S&P 500 dropped 23 points today. The Nasdaq a 32-point drop, a 0.1%. Let's take a look at the movers in Toronto. Transcontinental is where we start today. It gained 19% or $3.79, taking the share price to $23.66. That is on an agreement to sell its packaging business. More on that in a moment. Fairfax climbing today up 4.7%. That's a $109 improvement for the stock. It's at $2,431. It's up 18.5% on the year. Celestica also a gainer on the day. It moved up over 5% or $23 to end the day at $472. Over the last year, it has moved up 251, almost $252 Curaleaf is a cannabis company that's been bouncing around in recent weeks. It is down today 6.6%, losing a 25% to $3.25, to $3.54. And then Ivanhoe Mines also dropping today 4.4%. It lost 65 cents, taking it to $14.07. Let's get more on the movers from Bloomberg equities reporter Stephanie Hughes. She joins us now. Stephanie, that transcontinental deal today, an agreement to sell its packaging business. How big of a deal is it?
Well, apparently by the share price movement, it is the pretty big deal, seeing as shares moved up by over 29% at their highest point. That briefly marked its biggest intraday gain of all time, and it was enough of a boost, in fact, to bring the share price to levels that we haven't seen since 2021. But like you mentioned, this was thanks to transcontinental deal where it will be divesting from its packaging business and selling it to ProAmpac Holdings for $2.1 billion. Now, aside from that price tag, what this also does is it helps Transcontinental focus on its retail services and printing business. So this also got a surprise, like it was met with surprise and positive reaction from the analyst community, including TD Cowen's Sean Stewart, who called it a surprising development in some respects, adding that the acquisition initiatives surrounding the packaging business had been put on pause in recent years. But he said that this deal was considered a focus on the long-term assets and is expected to close in the first quarter next year. So this also prompted National Bank analyst team to raise their price target on the company. So it's being well received by traders, analysts, and it accounted for, today's share move accounted for most of the year-to-date gains so far with Transcontinental, Morella.
Okay, let's talk about Transat under pressure today with the pilots issuing a strike notice. We already saw that strike from Air Canada that did a number on travelers in the summer. So how much of an impact could this one have?
Yeah, it's interesting. So today we're seeing some share price reaction. Transat fell by nearly 4% at its lowest point, which isn't a massive move for the vacation operator, but it is directly tied to the news that came out over the weekend where the pilots issued that 3-day strike notice, as you mentioned. In a statement, the company said that the strike would officially begin on Wednesday, and that they are working to reach a resolution. They did end up canceling some of the flights as this sort of gradual suspension of operations just to prevent some passengers from being potentially stranded elsewhere. So TD Cowen analyst Tim James said the strike notice will affect the financials in the first fiscal quarter next year. But then argued that the dispute should be resolved without any longer-term financial impairment to the company. He said that the seasonal travel trends and government intervention might or should minimize the full extent of the labor disruption, and that traders should actually focus on the long-term prospects for the company, like an improving economic picture in Canada and the demand for travel. That said, James said that investors should be expecting some near-term volatility in the share price, and I suppose that's exactly what we're seeing today, Marilla.
All right. Stephanie, thanks for the update. Appreciate that. Stephanie Hughes, Bloomberg's equities reporter. Coming up next, we'll have a look at the markets. Investors weighing the possibility of a rate cut in the U.S. by the Federal Reserve announcement on Wednesday. Back in a moment. North American markets in the red to start the week. Investors on the sidelines maybe waiting for central bank announcements that come on Wednesday. Let's go to Scott Ladner, Chief Investment Officer at Horizon. He joins us now. Scott, thanks for joining us today. So year-end volatility is what we seem to be seeing. What do you think is driving that?
Hey, Marilla, thanks for having me. Look, as far as the year-end volatility, it's just people trying to get positioned and set up for next year. Like there's a pretty popular trade setup going on right now. It feels like people are trying to kind of get out of some of the Mag 7 names, kind of get out of the AI, like the semi kind of names, and get more into a broadening type of trade. Think cyclicals in the U.S., oil companies in Canada, things like that, which we think actually have a pretty good shot to perform well next year.
Okay, so is some of this, you think, just rebalancing for the tax year?
Yeah, probably a little bit of that, but it probably, frankly, it's just a little bit more of sort of repositioning portfolios and getting out of the winners from this year and getting into what you think are going to be the winners for next year. You're not seeing a very high volatility at the sort of index level, but you are seeing quite a lot of volatility inside the market. So that the volatility of individual stocks and sectors is rather high. While volatility at the index level is somewhat muted right now.
All right, you've mentioned the tailwinds for the markets, like the bank decisions, but some of that's already priced in. So when you take a look at it, how much of it is priced in?
Actually, we don't think very much is priced in so far, Marilla. It is, this is a Trump administration that has not done, frankly, very much on the regulatory front thus far. We think that they're taking a friendly stance on some things, but they haven't really done very much in terms of easing regulations, in terms of really signaling to some of these medium and larger sized banks that easier times are going to come. So we actually think there's quite a lot of tailwind in for next year, as it becomes fairly clear that the focus for the administration is going to shift from the tariff policy and from some of those industrial policies more towards a friendly regulatory regime. We think it just really hasn't been a focus for the Trump administration in year one, but we think it will be in year two.
Some of that will come through the One Big Beautiful Bill, of course. How strong of a tailwind do you see from that, and anything specific from that you see working out in favor of the markets?
Yeah, really, I think that the one big thing out of that bill is the full expensing of capex, expenditures for U.S. domiciled companies. This could be a rather massive and really underappreciated, we think, thus far, tailwind for U.S. for basically large scale corporates or large cap corporates. You're talking about if people really take advantage of this, if companies really take advantage of this, you can see effective tax rates in the United States be 11-12%. We haven't seen that kind of level of effective tax rates in this country for 50 or 60 years. And we don't think that is really in the price just yet.
Okay, let's talk about AI a little bit more, because you mentioned there's rotation sort of out of some of the AI winners to date and more into sort of cyclical kind of stocks or companies. Where do you see the AI trade moving to for the start of the next year?
Yeah, look, we do think that we're going to be moving out of this place where chips, semiconductor chips are really the way to play AI in 2025 and in 2024, really. We think in 2026, the way to play AI is going to be more from an infrastructure standpoint, more from a power delivery standpoint, because 2026 and 2027 are going to be the years where AI has to diffuse through the entire economy, not just in the U.S., but globally. And in order for AI to actually diffuse through an economy, you got to be able to deliver it. And you got to be able to generate the power and the infrastructure necessary to actually run these models at scale across a large section of organizations. And so that's like that to us is probably the more interesting play between the infrastructure stuff and industrials and some of the the pharma and healthcare names that we think could be some of the first beneficiaries of drug discovery advancements.
Yeah, let's talk about that a little bit more, because on the energy play, we've already seen some stakes go in for that, but you think there's much more to come.
Yeah, we do, because it wasn't really like demand for AI. AI power generation has been something people have been looking for, but we haven't really seen it that much yet. I mean, it's impacted energy demand thus far a little bit in this country. It has not been really large scale though yet. As we kind of move into the place where AI goes from something that's more of an idea and really something pretty cool to play with, something that's integral towards the running of businesses, large scale, across the economy, you're going to see those energy demands really start to pick up, and that's when we're going to see some of this we think really start hitting the equity prices and the equity values of some of these companies.
Some of that would also be construction plays.
Construction, certainly. I mean, look, we got to build a lot of stuff. Not only on the energy infrastructure, but just the structure of like all sorts of manufacturing things, both here and in Canada, are actually they're pretty old. And so and with the with the incentive structures in place from the Big Beautiful Bill, in terms of being able to expense those things immediately, you're going to see a pretty big tailwind, we think, towards just replacing of structures on the manufacturing side and towards building new energy generating types of structures, especially in the U.S.
Okay, you talked about this, or you touched on this, fact that AI has to now sort of filter through to the rest of the economy, and there has to be some sort of return on revenue for those investments. Pharma is something we expected, healthcare, medical, pharma, we expected to see some strength there already from AI, but that really hasn't happened yet.
No, it hasn't. That's well pointed out, Marilla. Look, this is this is a space where we're excited by it. I mean, if when you think about some of the things that that AI might be able to do in terms of speeding drug discovery, new drug discovery or testing procedures, analysis of data, those types of things. We think this is one of those potential, it's sort of potential energy type kind of thing, but we're not seeing that potential energy turning into any sort of kinetic money just yet. We're not seeing any evidence of kind of large scale drug enhancement or large-scale, like drug development enhancement procedures, and that's we think we're going to see that this year, but we need to start seeing it actually before we're going to really start putting our money there.
Got it. All right, Scott Ladner, I'm going to leave it there with you, sir. But thank you for your time, Scott's Chief Investment Officer at Horizon. Coming up next, China's trade surplus has exceeded $1 trillion, despite the decline in shipments to the U.S. More in a moment. All right, a quick look at where we ended the day. It was a Monday in the red for the North American markets, with the TSX dropping 141 points today, about almost 0.5%. And the S&P 500 23 point down, so 0.4%. The NASDAQ Composite losing 32 points today, so it's at 23,545. Can we take a look at some of the movers in Toronto? We had a deal for one company that meant a big jump in its share price today. Transcontinental gained 19%, so it's up 33% over the year. But it announced a deal selling part of its business, moving the stock up $3.79 to $23.66. So that was the biggest mover on the markets today. Washington has stacked tariffs on many countries around the world, but it hasn't stopped China from reporting $1 trillion plus trade surplus. The European Union, Africa are some of the countries offsetting American demand. Let's go to Sean King. He's Senior Vice President at Park Strategies. We'll talk some more about this. Thanks for your time today.
You got it.
We often talk about how difficult it is for countries to find new trading partners. Clearly not the case for China. Why is that?
Yeah, and when we say $1 trillion surplus, it's not with any one country, but the world. China's economy is a state-driven model that's very internally focused. Part of that surplus is due to the weakness of the Chinese consumer. Their imports are much less than in other countries. But I think Beijing is smart enough to look around demand from the U.S. in the wake of the tariff war and double down on other markets and other free trade arrangements it has around the world. So while exports to the U.S. are down 29% year on year, and they probably really would have been worse if not for U.S. customers front-loading to avoid the pending tariffs, they've doubled down on markets in Africa, Southeast Asia, and even windbag Europe, who's always rightfully complaining how much Beijing is enabling Moscow's war machine in Ukraine, but their purchases from mainland China are up 15%. So while we sort of entrench and scold our allies, China's looking for more opportunities around us, and that's not good. Okay, so is it clear what kind of goods some of these other countries are picking up that perhaps originally were destined for the U.S.? Well, a lot of it is low-end stuff like toys and clothes, but also technology, also critical minerals and rare earths. And just in the interest of full disclosure, we represent a tungsten producer called Almonte Industries, which is sometimes lumped into this space. So a lot of the same stuff, everything from shoes to high-end tech gear that they were selling to us, they're now selling to other countries.
Okay, and
more of it.
I also wanted to find out if we understand yet what the U.S. front-loaded from China, what they're not bringing in these days. And I'm sure China has found some workarounds to still get some things into the U.S., but seemingly it doesn't trace back to China.
Yeah, I mean, the fear is that they're using countries like Vietnam as ways to launder trade into the U.S., and customs officials are very alert for that. And a lot of U.S. importers bought a lot of goods early and then were upset when Trump then put off certain tariffs or delayed others, saying that we bought all this stuff ahead of time and now you're putting off these tariffs. I mean, part of the problem with Trump, too, is that the tariffs are on again, they're off again. China, say what you will, at least they're consistent. You know where they're coming from, and they're going to sell to any autocratic regime anywhere in the world. And then even though it's U.S. importers who are on the hook to pay the duties, sometimes they work out a back deal with their mainland Chinese supplier to cover the costs or split the cost between them. But that may only last for so long. If this goes on for another year or so, mainland Chinese suppliers may just tell U.S. buyers to look elsewhere, that they're on the hook totally for the tariffs themselves. So we're in very uncertain, uncharted waters here.
Are you surprised that trade, worldwide trade, has not just been completely paralyzed? Because as you mentioned, at the border for the U.S., they've got to try and figure out where goods are coming from, if there's a workaround at play, if they're originally from China but coming through Vietnam. And there's so much that passed through so easily before. Are you surprised we aren't seeing more paralysis around trade routes?
No, because the U.S. is not as export dependent as other countries and import dependent as other countries are anyway. As I've joked in this show before, Bono from U2 once said, America is not a country, it's a continent. So we need the outside world less than other countries do. And while we're entrenching, a lot of other countries are reaching out. China and India are part of this regional comprehensive economic partnership. You see Japan and now Britain. Japan's taken leadership up, and Britain has joined the Trans-Pacific Partnership, which we unfortunately left in 2017. You see Canadian Prime Minister Carney at the G20 looking for new opportunities and trying to mend fences with India. And obviously Europe is looking for alternatives and trading a lot within itself. So just because we're turning inwards doesn't mean the rest of the world is waiting. They still need stuff, and they're smart enough to see the opportunities elsewhere. So no, the net numbers for the world as a whole do not surprise me.
Can you see other countries becoming more protectionist as a result of what's going on in the U.S.?
Not necessarily. I think they are becoming more protectionist, maybe in response to what we're doing. So they may put up walls to get the U.S. back for what we've done to them. And hopefully, they become more protectionist against unfriendly regimes like mainland China. Now, I've lived enough around the world to know that there's a lot of resentment of the U.S. and other countries, but there's a lot of goodwill toward the U.S. right now, basically because people are so upset with Beijing and Moscow on various human rights and other national security issues. Particularly in Asia, I see in South Korea and Japan, there's a very pronounced pro-American feeling, and people want to do more business with us. But they feel it's unrequited love, that we don't love them back as much as they love us. So other countries, again, are smart enough to break down barriers between and amongst themselves to possibly make up for the shortfall in U.S. trade and investment.
All right,
and I see that in Asia a lot.
To go back to what we started this discussion with, and China and the amount of exports being over $1 trillion, you mentioned that it is on the backs essentially of the Chinese civilians, the Chinese workers in the country. Can you see that changing at all?
No, I see it's a state directive mercantilist system. And this China 2025, which has kind of been forgotten about, but China seeks self-reliance, especially in technology, so it can use it to control and coerce its own citizens without dependence on foreign sources. But I see China also looking inward, doing more business with autocratic regimes like North Korea, Iran, and Russia, and also in the Middle East. And I don't see, unless the Communist Party is going to be out of business, which I don't see happening anytime soon. I mean, they just staged fake elections again in Hong Kong yesterday. I see the Chinese model continuing, if not strengthening, and becoming more inward and closed.
All right, Sean King, I got to leave it there, sir. Sean, Senior Vice President, Park Strategies. Thanks for your time.
Thank you.
So on the weekend, Elon Musk walked back comments that SpaceX is trying to achieve an $800 billion valuation before launching an IPO late next year. We'll get into that in a moment. Here are the stories we are following in the newsroom. Air Transat announced flight scheduled for today will go ahead as planned. It comes as a union representing more than 700 pilots issued a 3-day strike notice. The airline says they're working tirelessly to get to an agreement and minimize all disruptions to operations. Transat also announced starting today the company will be launching a special program to bring back as many travelers as they can. Some who were scheduled to return December 10th will return today instead, thanks to 4 additional flights. Montreal is hosting the G7 ministers to talk about artificial intelligence, quantum, and a range of other key digital issues. The 2-day event, part of a series of minister meetings with AI Minister Evan Solomon and Industry Minister Melanie Joly taking part. The gathering will have both an industrial policy agenda and a tech policy agenda. In June, a joint statement on AI said the G7 countries would work together to accelerate adoption of AI in the public sector to enhance the quality of services for citizens and businesses. The average asking rents across the country fell in November for the 14th straight month. Rentals.ca and Urban Nation show rents fell 1.5% from October to just over $2,000, the lowest level since June of 2023. The sharpest declines were recorded in BC, Alberta, and Ontario. The report says rents will keep going down with flatter population growth and economic uncertainty. IBM agreeing to buy data infrastructure company Confluent in a deal valued at $11 billion US. Some analysts believe the acquisition could significantly improve IBM's AI portfolio. If approved, the deal is also expected to boost IBM's adjusted core earnings within the first full year and also add to free cash flow in year 2. Over the weekend, Elon Musk walked back comment that SpaceX is trying to achieve an $800 billion valuation, U.S. of course, before launching an initial public offering later next year. The Wall Street Journal reported that CFO Brett Johnson told investors about a secondary share sale. All right, let's go to Bloomberg's Lauren Grush. She joins us with more details on the story. Lauren, can you explain, first of all, the insider share sale, what it looks like, what it means?
Yeah, so it actually didn't come as much of a surprise that this was going to happen. SpaceX does this twice a year, usually in July and December, where they offer the option to buy back shares from insiders and employees. So we were anticipating something like this happening, but it definitely, the number, I think, took us all by surprise.
Okay, explain where that number could come from, because past valuations put SpaceX at about, I believe, $500 billion. And I know the $800 billion number is not confirmed. But how would they get there? It's a big jump.
It's definitely a big jump. It's actually twice as much as the last time that their valuation was set during the summer. And, you know, obviously it can be somewhat of a subjective thing that is set, but there's also a lot that SpaceX has going for them, a lot of ambitious projects that they are basing a lot of this on. Obviously, a big one is Starship, which is their massive vehicle that they're building in South Texas that will supposedly take humans to the moon and Mars someday. There's also Starlink, which is growing at a clip and is fast becoming, you know, their biggest source of revenue at the company. They have more than 9,000 satellites in orbit at the moment, and they also just made that epic deal with EchoStar to buy spectrum for their sat-to-cell service. And then, of course, in recent months, Elon has talked a lot about putting data centers into space, AI supercomputers. So there's a lot of ambitious projects that could potentially be fueling this new valuation.
Okay, so at IPO being talked about for late 2026, would that include Starlink, or would the whole company go as one?
Yeah, now that also took us by surprise as well, because over the years, Elon and SpaceX president Gwynne Shotwell have always said that they would never take SpaceX public, or at least wouldn't take SpaceX public until they had achieved their dream of sending people to Mars. Obviously, we're not quite there yet, so the fact that they would take the entire company public is a bit surprising given those past statements. Additionally, most of the talk, as you mentioned, had centered around taking Starlink public, so spinning that off separately from the entire company. So the fact that this would entail an IPO of the entire SpaceX business is definitely a bit surprising.
Okay, we will leave it there. Lauren, thanks for joining us. Appreciate that.
Thank you so much.
Coming up next, G7 ministers meeting in Montreal this week to talk about the way forward and how to be collaborative in AI. More in a moment. Ampec announcing it will acquire TC Transcontinental Packaging in a $2.2 billion deal. We got more from the executive chair of the board at TC Transcontinental, Isabelle Marcoux.
We're thrilled this transaction delivers immediate and significant value to our shareholders at a substantial premium. Our stock used to trade before today at $20. We're looking at a transaction that will deliver $20 to our shareholders in dividend, and they will remain shareholders of TC Transcontinental, which is the other half of our business.
Mm-hmm. And yeah, so you're paying this $20 a share dividend. I think the amount, you haven't calculated it exactly yet, but it's about $20 a share?
Exactly, that's what it is. So it represent quite a substantial premium. We trade at 5.5 times EBITDA, and we're selling this business at a 9 times multiple, hence the premium that I've been referring to.
Right. So now, packaging in your latest quarter was almost almost $400 million. And then this other business, retail services and printing, was about $260 million, so smaller. But I noticed its profitability was almost as much as packaging, that latter business.
Correct. So our $1.2 billion retail services, print, and educational publishing business is a profitable business. It's a fully invested platform. It generates incredible cash flows. And with this transaction, we will be repaying debt, we will be issuing a dividend, and we will be left with a strong balance sheet that will poise us for further growth in Canada in those sectors of retail services and educational book publishing.
Oh, that's interesting. What kind of books? Are they textbooks that you publish?
So what we do is educational book publishing, so K-12, college, university, both print and digital, in French language. So we have built this business over the last 15 years from one acquisition to many others, and now it's a $110 million business, and it's a business that we want to continue growing.
Is that
on the print?
Sorry, go ahead.
On the retail services and print side, we've grown our ISM business, in-store marketing business, to just about nothing, to $300 million right now. In the past 3 years, we've made acquisitions in Quebec, in Ontario, in Manitoba, and that's a business we also wish to continue growing.
Sorry, I interrupted you there. The educational publishing, is that in France as well, mainland France, or France, or is it just in Quebec?
It's in Quebec mostly, but it's also in Canada, where French is taught as a second language.
Right. And then tell us about this retail business. What exactly does it do? Is it digital, or does it involve physical media?
So it's both. It's a simple description of in-store marketing is print and digital signage and temporary and permanent displays. So with our flyers, we bring people in stores. And as the retailers continue to invest in their brick and mortar, we dress up the store, so to speak. So in any given week, we ship at least one item to 30,000 retail stores in Canada. We see that as a growth area.
Flyers, that's interesting. That's a tough one, isn't it? I've heard in the past it's a battle of wits between the retailers and the shoppers. They want to offer good deals, but they can't give too much away, and the shoppers are pretty canny.
And the reality with inflation, shoppers are looking for discounts and retailers are looking to bring people in their stores. So flyers is still a great medium. We've transformed the flyers place certainly in Quebec and British Columbia with a new product that's called Radar. And in the rest of Canada, we distribute flyers.
So it's interesting, you're kind of going, but you started off as commercial printer, so you're only a very specialized printer now, but you made the trip into packaging and you're kind of returning to your roots here.
The reality is quite the contrary. The print company we were 10 years ago is quite different than a retail services and printing company we are today. It's evolved, this in-store marketing business. And the reality in the past 3 years, the acquisitions we've done were in that sector. They were not in packaging. Nice. The issue with packaging is very simple. We trade at 5.5. Acquisitions come at 9 times at least. So it's very hard to create value for our shareholders growing into packaging. We have invested heavily in packaging for organic growth, but the reality, there's limited volume growth and the pricing pressures are really hard. So for us, the best way to create value for our shareholders was to sell that business at a large premium. So what we're selling is really our U.S. assets to a U.S. purchaser, and we're excited to embark into this sharp focus we have on advancing retail services and educational publishing in Canada. We're really doubling down on Canada. We're a Canadian company headquartered in Montreal, 4,000 employees in Canada, and we remain committed and focused to grow those businesses here.
Isabelle Marcoux is the executive chair of the board at TC Transcontinental. Artificial intelligence will be a central topic at this week's G7 ministers meeting in Montreal. Let's get more from Stephen Caron, Vice President, AI Data and Analytics at Capgemini Canada. Thanks for joining us today.
Thank you for having me.
So does Canada need to collaborate with allies? And if so, on what fronts? I mean, I guess defense would be an obvious one.
You know what? The need to collaborate with our allies on all things artificial intelligence is growing more and more acute by each day. You know, the speed of innovation that's happening in this space is, simply put, just too difficult for any one single country, maybe perhaps outside of the U.S. and maybe China, to really wrap their arms around fully in order to truly grasp like the full maximum benefit for businesses, for citizens, across each nation. So I think the need to collaborate grows more and more acute every day. Absolutely, there are some specific areas or use cases where that need is perhaps most emergent, which is certainly touched on, one being defense. I think there's also an opportunity in healthcare. And surprisingly, there are some key verticals, including industry verticals such as energy, utilities, that are very important to Canada, where there really isn't a standard in terms of artificial intelligence, both in terms of applicability, but also in terms of the things that are perhaps a little bit boring around interoperability, where I think there is an opportunity for Canada to advocate for some close collaboration and some perhaps parallel investments to really make sure that this technology is of most use for the industries that are most critical to our economy.
What about finance?
Finance is one where we've seen across the globe different countries taking different approaches to how artificial intelligence should be applied within the finance sector. I think it is an area of potential opportunity, but I do feel that there are some specific areas, specific countries that already maybe have a head start on us. Specifically, there's areas within Europe that are really focused on how do you protect financial data and guard financial data with the use of AI with the right guardrails. And that is clearly a different position than perhaps the US will be taking as it relates to AI regulation. So that needle may be a little bit more difficult for Canada to thread versus other industries, as I mentioned, energy, utilities, even manufacturing, where I think there's more of an opportunity to collaborate and more of a willingness to collaborate as well.
Okay, so we're talking about the need to work together. That being said, we hear a lot of talk about the need for sovereignty in AI. Oh, yeah. So what does that look like?
You know what? It seems on the surface that these things are mutually exclusive, right? How can you have the need for collaboration while each country, Canada, the US, UK, Germany, France, all sort of investing in terms of sovereign AI infrastructure? And really, when you look at the two, they are sort of different, but they're not in conflict with another. I think what we're clearly seeing from the multinational AI businesses and AI enablers. So think, for example, the large hyperscaler companies that have made investments on AI infrastructure. Those investments are not only happening in the US, they're actually happening globally. Germany, for example, has done a great job of attracting private partnership through some of the major hyperscalers and NVIDIA into their AI ecosystem. The UK and France have done the same thing as well. And I think this is where, on the Canadian side, we can learn from our allies and our colleagues around what they've done to attract that investment and to see if we can boost our private sector investments that we're attracting in this country, because we are slightly behind some of our allies in that department.
Okay, so let's talk about regulation, because I'm wondering if countries or allies even agree on the need to regulate AI.
You know what? That's it's a very astute question. And the short answer is there is a bit of a difference of opinion right now in terms of how AI should be regulated. I think on one end of the spectrum, you may have countries like such as the US, which are very much focused on less regulation right now and more on private sector investment and private sector partnerships. And then you have some clear stakes in the ground some of our European allies have made related to the AI regulation. And I think this is actually where there's an opportunity for Canada to act as a bit of a bridge. We're somewhere in the middle right now where we're not actually as heavily regulated in terms of artificial intelligence with our European allies, and perhaps not as far on the other end of the spectrum as the US. So I think in terms of regulation, let's focus on the areas that are going to be critical to us. So you touched on defense. If we can have a set of standards around the applicability of AI in defense industries, including our private sector defense industries, that would be a fantastic boon in terms of just accelerating the adoption in a safe and pragmatic way. And also, I think there's similar opportunities to establish those standards in healthcare, as we talked about, and again, in the energy resources sector as well. And perhaps that is an area where Canada can take the lead position in terms of advocacy.
Okay, so now the more difficult question, Steve, because if other countries don't regulate in the same way, they have looser restrictions or looser regulations, what will be the risk then to us?
You know what? It's an interesting question, but I actually don't think a focus on regulation prohibits investments. So the great example of that right now is actually France and Germany, both within the European Union, both that are very much covered by the GDPR extensions around extensions into AI usage and AI applicability. But both of those countries have done a tremendous job in terms of attracting private sector partnerships and private sector funding into growing their local AI ecosystems. You know, Germany, for example, is north of 5 billion euros right now in terms of private sector investments. I think France is probably somewhere closer to now about 30 million euros in terms of private sector investments. So I do believe you can actually have a bit of a hybrid approach in terms of, yes, making sure that this technology is regulated in the right way with the right standards for our critical industries like healthcare, financial services as well, but also at the same time, still maintaining an attractive position for multinational organizations that are looking to invest in this space. And one of the things that we have going for us, Marella, is that we absolutely have the right talent in this country to take advantage of that investment, to commercialize those investments, to do further research. And I would love to see some investments targeted towards that area specifically.
Okay, it's one we will have to watch. Steve, appreciate you joining us. Stephen, Vice President of AI Data and Analytics, CAP Gemini Canada. Coming up, Hot Picks, we'll have a look at 3 plays in energy stocks. Back in a moment. Time now for Hot Picks. We zeroed in on 3 plays in the energy sector. We were joined by Stuart Glickman, analyst at CFRA, and we kick things off with his first pick, Baker Hughes.
Baker is, prototypically known as one of the big 3 in oil services. Of course, oilfield services depends on upstream capital spending by the big players in the E&P space. The ConocoPhillips of the world, the Devon Energies of the world, and so on. And oil services right now does not look that great. However, Baker has another avenue going for it, which is its industrial and energy technology business, which is very well levered to 2 emerging trends or developing trends, if you will, probably through the end of the decade. One being LNG exports, liquefied natural gas, and the second being data center growth. So all those data centers require lots of cooling technology to make sure that everything's working well, turbines to have everything function properly. So Baker has exposure in those areas as well. And right now, Baker's revenue story or profile, if you will, is about 50-50 between traditional oil services on the one hand and this industrial energy technology business on the other hand. The backlog is rising. The margins in IET are really strong. And we think it's going to be a key driver for Baker for the next couple of years.
Wow, I wonder would they be tempted to do some kind of spin-off to, as you know, unbury the value. I forget what the express, surface the value in
Unlock
that.
the value?
Yeah, go ahead.
So actually, it's an interesting question. They've actually done kind of the opposite. They have added to that, to their firepower in this area. They recently acquired Chart Industries, which gave them exposure, for example, into industrial energy technology that can be used in the mining industry, to which they did not have any exposure before. So it does look like they're using, they're intentionally diversifying. I think to be fair, the margins in IET are quite strong. So it's helpful to have that on hand, and it probably protects them to some degree if traditional oil services doesn't recover in the way they would like. So having that in your back pocket is probably a plus.
You have an LNG name for us, Cheniere. The LNG is even the ticker symbol, and they're a huge exporter.
Yes, Cheniere Energy, as you mentioned, ticker LNG, is probably the dominant player, the first mover in liquefied natural gas exports. So they are kind of a tolling booth for the industry. They have all the export facilities that will allow natural gas to be cooled, put on an LNG tanker, and shipped overseas to gas-hungry markets like Western Europe or Asia. And I think what Cheniere is benefiting from is that the U.S. is basically the low-cost leader when it comes to pricing for natural gas. Henry Hub, which is the U.S. benchmark, is somewhere in the neighborhood of about $4.50 to $5 per million BTU. If you look at similar benchmarks overseas, in Europe, the TTE is typically around the $11 to $12 per million BTU range. The JKM marker in Asia is in a similar neighborhood, around $12 per million BTU. So it does pay for these buyers overseas to pay for the shipping of that natural gas, move it from the low-cost place, and bring it over to their home markets. And there is certainly plenty of demand from both Asia and Europe. We don't think that's going to be changing anytime soon.
And then finally, Diamondback, another cute stock, ticker symbol FANG, was a Diamondback is a snake. What's the attraction here, Stuart?
Right. So Diamondback is a pure play in the E&P, in the Permian Basin. Permian is the workhorse of U.S. lower 48 oil production. We are not particularly optimistic about oil prices in 2026. They've averaged about $66 a barrel in 2025 through November at least. And for 2026, we're only projecting about $63 a barrel. I think what you have here, though, is you have a consensus expectation on Diamondback and on oil producers in general for 2026 that oil prices are really going to disappoint. The EIA is calling for about $51 a barrel next year. We think that's a bit too pessimistic. And secondly, Diamondback gets about 20 to 25% of their production in the form of natural gas. One of the problems that has been sort of chronic in the Permian Basin in the last several years is not enough takeaway capacity out of the Permian, and so that's weighed on pricing. But just recently, there's been an expansion in that takeaway capacity. There's more to come in 2026, probably through 2028, actually. And what I think this means is that realized pricing for natural gas for pure plays like Diamondback in the Permian, probably not going to be as pessimistic or as lousy as it's been the last couple of years. So we think that improves. And so our estimates for earnings power for Diamondback are better than what the consensus is at right now.
Stuart Glickman, analyst at CFRA. Let's have a quick last look at the markets for the start of the trading week, end of the trading day. The TSX dropping 141 points today. The S&P 500 down 23. And the NASDAQ composite losing 32 points today. That does it for the close. Thanks for joining us today. We'll see you back here again tomorrow.